I'll introduce Adam and Pari together. So the first talk is a joint presentation. It will last for 1 hour. The first speaker is Adam Solomon, assistant professor from New York University. And also Adam is also Australian. He's actually a graduate from my university, UNSW. And also dropped out from our Q program. So clearly economics is more attractive compared to actual studies. And Pari is assistant professor here at Wharton School in finance, right? And both of you graduate from MIT with a PhD. Yeah. Okay, now their topics are AI and insurance market failures, and it's a joint presentation. It will last for 1 hour.
Cool. Thanks, guys. So I'll talk a bit. Pari and I will sort of go half and half, and then maybe we'll take some questions. We've put a relatively provocative title here. We don't mean to, attribute blame for any such failures, whatever those may be, to the insurance industry. But we are optimistic that AI can definitely help with some sort of like gaps in availability and coverage and contracts and this kind of thing. And so we want to sort of talk through that and brainstorm. So, insurance, many things go wrong when we're trying to sell insurance, just because of the structure of information or the structure of contracts or regulation and all sorts of things. And so what we're going to do today is sort of list out where do we see some shortcomings in the current insurance market or the sort of contracts offered by the industry, and will AI improve some of those shortcomings? Will AI potentially make some of them worse or introduce new problems entirely? So I'll talk about the supply side factors, which, we've talked about, we've talked a lot today about sort of underwriting, in other words, like pricing the risk, and obviously AI is going to have a bunch of impacts on that. We'll talk about modeling, sort of through the lens of catastrophe risk, and speculate there. And then more generally, these questions about claims monitoring, claims verification, AI is going to impact both sides of that, whether AI can enrich the types of contracts that people find it interesting to offer. Find it economical to offer. And then Pari will talk about supply side, coverage gaps, sort of demand gaps, people not being willing to pay very much for insurance, and the interesting interaction between insurance and mortgage markets. Okay, so AI is definitely going to change things. It's probably going to improve some things, and it's probably going to make some things worse. Hopefully this is, another controversial place to start. And, trying to understand which of these upsides and downsides already sort of coming, like being used in practice, are turning out to be relevant, are turning out to be less relevant, is something we would love to learn as well. So please let us know. Great. Okay. So we want to hear about how this is actually impacting the practice of selling insurance. So, okay, for example, the first thing that's difficult about insurance is that you have to figure out who you're selling the product to, obviously. You have to underwrite the risk. And to do so, you get people to take medical exams, or you go inspect the property, or you look at the books and all this kind of stuff if you want to write a business liability product. AI, ideally, can reduce the cost of a lot of this kind of stuff. You can ingest massive amounts of data. You can price risks much more granularly. Maybe underwriting can be done much more quickly and without less human intervention, and therefore at a lower cost. This potentially can sort of, as we've talked about a lot today, if we're priced on credit risk, priced on other things, make things more accurate, which maybe will bring people into the market who didn't want to come into the market before because they didn't feel like the price reflected their risk or the price reflected good value for them. But on the other hand, as we've also alluded to today, as soon as you start pricing more granularly, this means there's no risk pooling between people. People who are otherwise or previously indistinguishable are no longer are now distinguishable. And it's possible one of those two people who used to be pulled together says, oh, actually, at my new personal price, I'm out of here. And then at their new personal price, the other person is not so happy because they're not being pulled with the other potentially better risk before. And so, there might be a lot of competitive dynamics to price more granularly and price more accurately and price more precisely. And this may have sort of knock-on effects to who gets pulled together and therefore who buys overall and how much of the market is covered. That any particular pricing decision sort of doesn't take into account. So, for example, there's lots of examples where additional information, additional pricing factors, additional covariates in your model not always an improvement for the market as a whole. And these are the kind of provocative, maybe the things that may turn out to be an issue here that we want to make sure. So, okay, there's, an old paper basically, which is about, what happens when you include a new pricing factor into an insurance contract, essentially. And the key trade-off is everybody's price today becomes more accurate, but as I think Ben alluded to before, you now lose the implicit insurance against becoming that high risk factor in the future. In other words, if today we can't distinguish between people who have a high or a low propensity to develop Alzheimer's in 30 years, for example, everybody gets pulled together and people are implicitly insured against becoming higher risk in the future. If our, genetic information and AI predictions based on that get much better, then suddenly everybody today is either high or low risk. And so somebody who's going to become high risk in 10 years doesn't have that insurance because it's priced in right now. And so pricing can get more and more granular, and that in a static sense helps with accuracy, but may have this dynamic knock-on effect, this reclassification of this problem. And then there's another sort of macro consequence of a micro pricing decision, right? Which is, when do certain insurance markets just unravel in general? When can no product be offered? And sort of you might think of this as like, what are the rejectable factors when it comes to long-term care insurance or life insurance? And you have to ask, okay, like, why can we not sell long-term care? Why can we not sell life insurance to this particular class of people at any price? Even if their risk is sufficiently high. And there's some theories about, it's because, the information is too dispersed, their private information is too dispersed. In other words, the people who are within this rejectable class, it's not that their risk is too high. A higher price could deal with that, but there's too much sort of internal variability in their risk. And so the high, within that class, the people who choose to buy and the people who don't choose to buy are too different. And so this is all to say that what AI is definitely going to do, it's going to allow us to carve up risk classes more and more finely. And what remains afterwards are going to be these like finer and finer subgroups of people, instead of just, age and sex. So obviously things are more complicated than that. It's going to get even more granular. And the question is like whether within these more granular subgroups, there is better or worse risk pooling, better or worse unraveling between the fact that like now some people within these subgroups know they're a bit higher or a bit lower relative to the broader subgroups. Okay, great. So that's on underwriting. Another thing, underwriting, obviously relevant to a lot of P&C and this kind of stuff. The other type of pricing that's come in is when we're trying to think about natural disaster risk, right? And so one very plausible outcome from AI is that the catastrophe modeling that's currently quite expensive and difficult to do could become much cheaper. It's possible that like high-tech models, or at least access to them, is going to be much more widely dispersed. And so the barrier to going to Verisk or AIR or, reinsurers and this kind of thing and getting a high-tech catastrophe model done is going to be much lower. But it's not clear, therefore, if that's just going to mean everybody converges to the same amount of information, or there's a sort of, once everybody has this very high common baseline, if small factors of sort of proprietary data, idiosyncratic data, this kind of stuff become even more important on top of this even more common baseline, right? Could go both ways. And I've got some examples here on the next slide of just how people are now trying. There seems to be now a huge return to non-standard information or sort of atypical information relative to the past. And so you can democratize high-tech models. People are still going to compete on something, right? And do we want them competing on, well, what I'm about to show you, right? So, there's plenty of reasons to think that as models get better and access to good models gets wider, this is going to be good. So there's a lot of evidence already about how, when models are more uncertain, prices go up, regardless of risk. People are just more uncertain. They need to sort of factor that into their prices. There's evidence of this in Florida hurricane pricing. There's evidence that when you, I've done some work on this, that when you remove ambiguity, in other words, you tell everybody you all have to use exactly the same model, you can't compete on this, prices do decline. And so this is, evidence in both directions for the same idea. But here I've taken an interesting, maybe this is too small to read. This is a company in New York that is offering free house cleaning. So long as when the people come and clean your house, they can be recorded so that the recording of the people cleaning your house for free can be used to train future LLM models. I've heard of similar things where people are now, after disasters, sending people into disaster zones to try and take photos of damage much faster than official damage reports are coming out, so that the relevant catastrophe bonds or insurance company portfolios in some way can be traded. Right? And so as soon as you have this, we've democratized, we've sort of lifted the baseline of information everybody has, and suddenly the advantages to being just a little bit better than everybody else might be much higher than they were before. Great. Okay, so the other thing I'm hopeful AI will do is enrich the type of contracts that can be offered and that people will find it sort of attractive to buy. So obviously we've talked mostly today about sort of standard indemnity contracts. House gets damaged, damage is repaired. They have some of these issues that we've talked about, and there's always been attempts in various contexts, often developing countries or in national contexts, to try and not use indemnity contracts, but use parametric contracts, use index contracts of some form. The problem with parametric contracts, index contracts, as we all know, is because they're not paying off according to a personal realization of risk, but according to some aggregate realization of risk, there's basis risk. There's a gap between your loss and the thing that the parametric contract pays upon. One hope I have for AI, or aspiration for it, is that because it can aggregate, it can get more granular information, and it can process a lot more information much more quickly, we might be able to write contracts based on parameters that are much closer to being personal. Instead of just, is there, does the hurricane make landfall as a Category 5 or a Category 4, we could get precise signals of wind speed in not just zip code, maybe in a block group or in a street or at a particular house and this kind of thing. Right? And so to the extent that you can enrich the type of data you collect and enrich the type of analysis you do, we might be able to do something that's like between the standard parametric contracts and the standard indemnity contracts that manage to get the best of both worlds, or at least a little bit of the good of both worlds. The speed of parametric contracts, the transparency of parametric contracts, but the lack of basis risk of indemnity contracts. So we are actually getting close to personalized risk. Great. And my last point is that a lot of money, as we all know, is spent on verifying claims in insurance. Right? So, I took just from the NAIC records that I think last year was about 10 to 15% of loss adjustment expenses. 10 to 15% of premiums were spent on loss adjustment expenses. And the impact of AI here could go either way, right? So this is a pitch I found online for some sort of startup that is proposing that AI could reduce claim resolution costs by 20 to 50%. And help the specialists who resolve these claims be 50% more productive. So that's good. AI might help. And then the bottom picture is a ChatGPT generated photo of an accident that was submitted to an insurer in the UK. Right? So this is basically an arms race between people who are trying to do dodgy things, after the claims, and then the insurance companies are trying to verify what's real and what's not real. And so it's it's true that claim resolution costs may go down by 50%, but the cost of submitting a fraudulent claim may go down by much less than 50%. Right? And so which of these wins is obviously a question for governance and a question for regulation, and just an important thing, because technology is dual use in this way, right? It makes good behavior easier, it makes bad behavior easier in almost exactly the same way. All right, fantastic. So that's me on supply, and I'll hand over to Pari.
Thanks so much, Adam. So I'm going to cover the demand side of insurance and to kind of set ideas, thinking about how households' use of AI may change the insurance markets. So before I go into the details of AI, I kind of want to set ideas about the basics of property insurance demand. So if you describe homeowners insurance in a class, if I'm teaching, it's a very simple contract. You pay a premium every month or once a year, and in the event of a covered loss, you get a claim payment. It's a very simple contract in theory. But then you actually get into the details of the contract and you realize homeowners insurance is an extremely complicated, multi-dimensional contract. So what are the different dimensions? The first is, which company do you have a homeowners insurance contract with? I took an informal survey of my colleagues in the Wharton Finance Department, presumably people that know a little bit about their financial portfolios, and about a third of them didn't even know who their homeowners insurers was. So that's the first dimension, who's actually providing your policy. The second dimension is, of course, the deductible. So how much are you paying out of pocket at the beginning versus your insurer? And now we have carved out deductibles. So now there are special deductibles for hurricanes, special deductibles for fire, etc. So not only do you need to know your regular deductible, you sort of need to know if you have separate deductibles for different perils. And then, of course, there's how much coverage do you have. Now, coverage is a stand-in for 50 other things. So you have a DO, HO1, HO3, HO5, HO8, and then there's the coverage limit, and there's your coverage A limit, your coverage B limit, your coverage C limit, and then you have actual cash value coverage, you have replacement cost coverage, you have extended replacement cost coverage, you have guaranteed replacement cost coverage, and if you have actual cash value coverage, there's a co-insurance penalty. So how much are you going to actually get is going to be a function of this penalty. And then there's what perils are covered. So maybe you think you have, full standard umbrella homeowners insurance policy, but in fact you have a certain set of perils that are not covered under that policy. So for example, earthquakes are not covered in a standard policy. Flood risk is not covered under a standard policy. And then you have insurance for your structure and insurance for your contents. So sometimes people may not know that those are two separate lines that you choose. And then finally, you can also bundle across lines of business. You can bundle homeowners insurance with auto insurance. So now you need to think about all the same things, your deductible, your coverage for your auto policy, and disentangling what is going to cover your home and what is going to cover your car. And households are making these decisions with kind of in the context of living their day-to-day lives, right? People have jobs that aren't just reading their homeowner's insurance contract. And so an important question kind of in the literature for us is trying to understand how households actually choose along each dimension and what are the consequences of these choices. And importantly, and I'm going to get to this again, do they even understand what they're choosing? Do they even know? And to complicate matters further, at the same time that you're choosing a homeowner's insurance contract, most households are also originating a mortgage. Usually you're buying a house, you find something you like, you have 3 months to close your mortgage, your lender tells you have to get an HO policy. So you have 3 months to figure this out. And so then not only are you sort of choosing all of these contract features on your own, there's stuff that the lender is forcing you to get. Lenders have requirements on the maximum deductible you can get. Lenders have requirements on the minimum amount of coverage you can get. And in fact, I have some work on this, and so do others in this room. The price you get on your mortgage and the down payment you're allowed to pay is also a function of the insurance contract that you get. And so then the big question, if you're thinking about just homeowners insurance, again, I'm abstracting from all the other insurance contracts we've talked about today. If I want to know as a household, what actually will I get in a natural disaster? It's going to actually not just go to me, it's also going to go to my lender. So that's not just what do I get, it's what do I get versus what does my lender get. So now we're in this insane 1,000-dimensional space of contract design, right? And so all of this is not going to just affect my own well-being in the event of a natural disaster. All of this is going to have knock-on effects on the mortgage market, the housing market, maybe the banking system. And so understanding how households make these very, very micro-level decisions has broader repercussions. So what do we actually know? So this is a multidimensional contract. What do we actually know about how households choose? Honestly, the answer is not that much. We have not historically had great data on insurance contracts. Regulators like Philip are able to ask for this, but as Ben mentioned earlier, we ask, but you guys don't give. So what we would ideally need is contract level information on what all of these different dimensions I mentioned that households are choosing. And we would, additionally to that, we would need all of the stuff that insurance companies use to determine risk, whatever that might be. And the best available data that we had came from these NAIC filings, which were basically aggregated premiums information at the state by insurer by year level. So there's not a ton that you can do with that to understand how individual households are choosing contracts. But the good news is there have been recent data advances that have brought extraordinary visibility into these markets. So for the first time, we actually are able to get better granular information about how households are making choices. So in 2018, the National Flood Insurance Program released an API, which gave contract-level information on flood insurance policies. A couple years ago, ICE McDash created a data set where they were able to provide contract-level information on homeowners insurance. And there have been various data collection efforts happening through the NAIC where they've made information available not at the contract level, but at the zip code level. And because of these recent advances, in the year of 2026, we're actually starting to get some answers to basic questions. What are some of the answers? Unfortunately, the answers that we're getting, it's good that we're getting them, but the answers are concerning. And so I'm going to kind of first talk a little bit about what the answers are, what we're learning about household choice. And I think I'm going to then, in the context of those questions, discuss whether AI is likely to make these problems better or make these problems worse. And as with Adam, it's going to cut in both directions. What is a big trade-off that I'm going to focus on? AI is going to give households unprecedented access to information, and it's going to give them processing power. It's going to allow them to process this volume of information in a way that we never had before. So that's a very amazing attribute of AI. Households are going to be hopefully able to make better choices. That would be the hope. However, the availability of AI may exacerbate existing divides. Not everyone is going to use AI equally. It's very likely that more sophisticated people will use AI more. So this may actually exacerbate inequality due to selection in AI usage. And furthermore, insurers and other private sector entities can try to manipulate AI in order to advantage their own businesses, and that may also exacerbate existing divides. So I'm going to talk about both of those. So first, what are the things that we're concerned about in light of the new data that's released? The first is that there's a massive flood insurance protection gap. So some of this was known even prior to the 2018 releases. But the releases have only made these facts even starker. So what is flood insurance? Flood insurance in the U.S. is actually not. It's predominantly provided by the U.S. government through the National Flood Insurance Program. It's well known to be heavily subsidized, so the NFIP is losing money on a year-to-year basis. There is a requirement to have flood insurance, but only in government-designated flood zones. And these contracts have a cap. There's a $250,000 coverage limit for households and a $500,000 coverage limit for businesses. So what are the stats? Only 4% of households have flood insurance. That means 96% of American households don't even have this contract. And if you think about the coverage limit, $250K, how much insurance does that provide? That covers basically the 30th percentile of homes in Florida. So this coverage limit is binding for about 70% of Americans. Why is take-up so low? A lot of it, according to a survey done by Swiss Re, is that people think they have flood insurance. They don't realize that flood is not part of their homeowner's insurance contract, that it's separately carved out. So a lot of this is just people are making mistakes. There's also evidence from the literature. This is much smaller than I wanted, but the paper is by in Barrage 2022, that people underestimate their own risks. They just don't think that they have as much risk exposure as they actually do. So even if they know flood insurance is not a part of homeowners insurance, they just sort of have mistaken beliefs about risk. And for the 56% of people who are mistaken about flood insurance, many of them discovered the distinction between flood insurance and homeowners insurance in the worst possible way, which is when a catastrophe actually happens and they're trying to find a claim. And so a lot of work has been done. I just have some newspaper clippings here. In Hurricane Harvey, which was one of the most devastating hurricanes in the last decade, the majority of homes that were flooded were outside of a flood zone. So they were in parts of the state that weren't required to have flood insurance, and most of them didn't have flood insurance. And there's an estimate from CoreLogic at the bottom of the size of the flood insurance protection gap between 25 billion to 37 billion of people are not insured against, of dollars are not insured against flood risk. This is a first order issue in the flood insurance literature. People don't buy flood insurance. So what can AI do? Well, maybe I can put my homeowner's insurance contract into ChatGPT and be like, hey, what am I covered for? And ChatGPT will say, you know, you're covered against A, B, C, D, and you're not covered against E and F. There's a special carve out. That would be an amazing usage of AI that would help address some of these behavioral mistakes that people are making. Of course, that would require that people even know to ask the question, right? That would require that people even know to ask GPT the question. And so there would need to be a sort of initiative to get households to even understand that there are these different distinctions across contracts. And so this is one example where it could be prudent to provide some of this information in the mortgage underwriting process. Maybe create a government checklist of here are all of the questions you should ask GPT when you decide to get a house, something like that. Because I'm a bit skeptical that households will even know to ask the question. But that is one positive potential use of AI. Now I'm going to switch gears a little bit to homeowners insurance. So the issues are a little bit different in homeowners insurance relative to flood insurance. The problem in flood insurance is that people just don't have a policy. In homeowners insurance, actually about 90% of households have a policy, so most people are insured. But the issue in homeowners insurance is the coverage limits that they choose. They don't have enough coverage to rebuild in a total loss. So I have some work on this, and we estimate that about 70% of replacement costs are covered by insurance. So a lot of it is insured, but not all of it. So in the kind of extreme tail risk scenario, people are going to be left holding the bag. And also, in addition to the fact that these coverage ratios are on average low, it's really the worst for the lowest income people with the highest amount of climate risk. So this is some of our data. This is showing the coverage ratio in homeowners insurance. This is data from on the household's income on the y-axis, on the x-axis, and we've broken this out by climate risk. So people in the high climate risk bucket are in the top 10% of expected losses. That's how we define climate risk. And you can see that across the board at all income levels, it's actually the case that high climate risk people have less coverage. And also that there's a strong pattern in income. And the other piece, which is you can see on the right, is that some of the states that we know have the highest exposure to climate risk, Louisiana, Texas, Florida, actually have the lowest coverage ratios in the country. The places with the highest coverage ratio in the country tend to be the richer states. So this is we don't want to be paternalistic, but a lot of people are worried about these low coverage ratios because there's a ton of evidence in the finance and economics literature that the amount of coverage that you have affects your recovery after natural disasters. You are slower to rebuild, so this is a paper, Cox and Gallagher and Mulder, where they have data from the Marshall Fire in Boulder, and they actually obtain rebuilding statistics and show the relationship between coverage and rebuilding. There's old work studying Hurricane Katrina that people actually, when they don't have enough coverage, they take on more debt to rebuild. And they're going to get a high interest rate when they do it. So this is kind of making household balance sheets worse. There's a string of recent papers on prepayment and default, which find significant evidence that households are sort of doing worse by defaulting on their mortgage or prepaying their mortgage. And I'll just add one more thing. Our paper on this suggests that the fact that households even have 70% coverage is a result of lender requirements. They would have actually chosen to get even less than 70% coverage ratios if they were kind of choosing on their own. So about 10% of the people in our sample are getting coverage that's exactly equal to the loan balance. And that's kind of controlling for replacement costs. And so on their own, households would get even less. But this means that in a prepayment, if households are using insurance to prepay their mortgage, that the actual insurance that they have is $0. The lender gets everything. So they're rebuilding on their own. So all of this suggests the kind of flood insurance protection gap, the homeowners insurance protection gap, is that people don't want to buy insurance. Household willingness to pay is extremely low, and it's way below their own expected loss. And the people with the lowest willingness to pay tend to be the lowest income people. There's a big literature on this topic because this fact about low household willingness to pay is true across insurance markets. It's also true in health insurance. It's also true in life insurance. It's also true in homeowners and property insurance. Why is it so low? There's sort of three prevailing theories. The first is that households are making mistakes. They're underestimating their own risks. They don't know their own risks. They don't understand the contract structures. The second is that it's all credit constraints. Households sort of want to pay more, but they're budget constrained. They have limited access to credit markets. And the third is that there's moral hazard from something else. Moral hazard from emergency rooms, or moral hazard from disaster aid, or other kinds of public forms of implicit insurance that leave households covered in other ways. So there's a big debate about why household willingness to pay is so low, but one of those is about behavioral frictions. And so one of the key roles that AI may play, again in the kind of both the flood and the homeowners context, is about potentially addressing some of these behavioral frictions. So what can you actually get information on from AI? If you were to sort of advise households on how to search for this information, you would want them to use AI to understand their actual risk exposure. So maybe if you're living in a coastal area of Florida, this is your actual probability of being hit by a hurricane, for example. It's something we would want AI to be able to tell a household. You'd want the AI to be able to explain to the household all of these dimensions of the insurance contract and what it actually means for their coverage and what they're going to get. You would also want households to know that construction costs change over time. So just because construction costs were something when they originated the mortgage doesn't mean 10 years from that point it's going to be the same. You'd want them to be able to compare different insurance companies on the basis of price and contract features. So you would want a sort of broker, like AI can kind of substitute for insurance brokers and provide this price comparison role. So that's kind of what we would hope. Those are the best case scenarios of AI usage. And as Adam mentioned, on the supply side, you would hope that AI could actually, for at least some people, lead to better premiums and better contracts. And that would maybe allow households to also choose among different contracts, maybe choose a contract that's better for them. And some of that could lead to addressing some of these affordability issues that may drive lower willingness to pay. So all of this would be good for society if it's the case that access to better information about your insurance contract, better information about your own risk, better information about prices can actually influence your decision to live in a high-risk area to begin with. If we think people are moving to an area and not sort of aware of the risks associated with that, having all of this information available through AI can alleviate some of those knowledge barriers or those knowledge gaps. So that's the rosy side of AI. That's the best case scenario for AI improving household decision making in a nutshell. What are some of the challenges? Of course, more information is not always better. And AI usage may not be equal, so it's likely to be the case that more sophisticated people are going to be the ones using AI. At Wharton, we're doing all this stuff to teach our students how to use AI, and we're changing our classes, and we're doing all this, whatever. And, not every school will be able to change curriculums at the drop of a hat. That's just one example, right? So the ability to use AI effectively is very likely going to be correlated with things like income and wealth and class and race, as we've talked about. Not all models and information, available on the internet is accurate. And how will households disentangle good information from bad information? There's going to be a lot of bad information out there. And can AI outputs be manipulated? So maybe I, as a company, am offering a really marked up price, but I'm able to pay a platform like GPT to have my company appear first in the algorithm. So households only see my price, right? They don't even see the prices offered by my rivals who don't have the ad budget. So this means that households will maybe be seeing only a partial view of what's actually out there. So AI outputs are likely to be manipulable as AI companies sort of sell off rights to the algorithm. And all of this can serve to exacerbate household behavioral frictions. So as an example on the right, there's this hotel that I always book in Cambridge, the Kimpton Marlowe. And every single time I book it, I Google it. And every single time I click on the first link. What is the first link here? Of course, it's not a link to the hotel. It's a link to a third-party website, Hotels One, that charges a markup to book at another hotel, right? And I am, whatever, low attention span, so I fall for this every single time, even though I know it, right? And I get to the hotel's one website, and because I go there every year, I know what the Kimpton Marlowe website looks like, and I'm like, oh, that isn't the right website, and I know to search for the other one. But this is an example of how a platform can kind of manipulate outputs in a way that will exacerbate existing behavioral frictions. And we have a ton of evidence of this in financial markets. So this small citation here is Campbell and Ramadorai, 2026. They have a new book, which is exactly about this point, that a lot of financial contracts, not just insurance, but kind of mortgages, credit cards, pensions, retirement accounts, are extremely complicated. And they tend to, one of the results of that complexity is that it tends to disadvantage lower income people or people with more behavioral frictions, and that can exacerbate inequality. So this is just one example of that. I'll conclude, and then we have some time for Q&A. We gave an overview of challenges facing insurance markets on both the supply side and the demand side. I think both Adam and I are aligned with what a lot of people said earlier. AI is going to change the informational environment for both households and insurers. Some of this will be helpful. Better information will hopefully lead to better pricing, and we'll have more data to be able to understand how people are making decisions. But there are some downsides. On the supply side, we know that not all companies are equal. There's going to be increasing returns to data and increasing returns to model. And so AI can create additional fixed costs and barriers to entry that will have impacts on competition, impacts on price discrimination, as we were talking about earlier. On the demand side, maybe the problem is going to be, the information problem for households will be addressed if they know how to use AI well, and if there isn't selection into AI uptake. But in reality, it's probably going to move the problem from who has the information to how do I discern among competing sources of information on the internet. It could just move the problem from one dimension to another. And so our take is that a lot of this is going to need to be studied, so we need more data, but also that there's likely going to be an important role for regulation, whether it's the regulation of the insurance industry or regulation of AI companies. We talked about that distinction a lot throughout the panels earlier. It's not clear what's going to need to be sort of done through the insurance industry or through regulating the platforms. It's likely going to need to be some combination. But thanks, everyone. And I think we are happy to take any questions.
I just have maybe a few comments instead of questions. For the supply and demand side, it's more from like insurer's perspective and from customer's perspective. So two things I want to comment on the supplier or the insurer's perspective. One is that AI can definitely help, let's say, some old companies with long history to mitigate technology debt. Because like cloud or so, just well suited for software developers to perform their tasks. And two is that it's probably easier for small companies to have better access to markets. But traditionally, I think one obstacle is that the insurance companies need to spend a lot of money, resources, building relationship with agents. But assuming that, or imagine that, if customers can just get insurance policies or quotes easily through ChatGPT or large language models, then insurers can just kind of use like MCP, multiple context protocols, and to connect ChatGPT through their database and provide policies or coverages through ChatGPT also. And two, on the demand side or customer's perspective, and one thing, just a couple of things as well. One is that, I'm not sure if you noticed, but in my company, we did some study or so. We found that some independent agents like Goosehat, their stock price has been declining a lot over the past few years. And we suspect that may be due to AI and helping customers pick their policies or so. And two is that one way to mitigate what you mentioned on the AI may provide incomplete or inaccurate information, that assuming that human-to-human interaction is still important, meaning that policyholders still would like to talk to agents. Maybe we can use AI to equip agents to provide better information to policyholders.
Definitely. On the supply points, I agree that it's both a very exciting and potentially scary prospect that, I could start an insurance company tomorrow and ask Claude, how do I build a hurricane model? And to be honest, you could, in a week, you could do a reasonable job. You could do something that's like, I've done this, I don't know anything about hurricane modeling, but for various economics papers, I've had to basically try and figure this thing out from scratch. And, with the current tools, you can kind of do it. And that's great. You can get more entry. You can lower these barriers to entry. You can get more people selling these products. The problem is, I think one of regulation. Who knows, how to stress test those models or what assumptions have gone into them, and how we should worry about stability and solvency and capital adequacy and all these kind of things. So I agree. It's all a double-edged sword, but a very interesting one.
And I agree on the customer side as well. We pointed at two different people.
Oh, did we?
Oh, sorry.
Oh, okay. Yeah.
Maybe let's go.
Yeah.
And then we'll go. Yeah.
I point at you and you
Thanks.
point at me.
Hi, thank you both so much. This was really interesting. I do a lot of research on how people find and understand information about climate risk, but I do it using very qualitative ethnographic methods because of the points you made about data access, right? And one of the things that I get from the people who do know about this stuff, right, is often for them that learning process happens through other people or soft information channels, right? And so I'm wondering if either of you have given thought to how that soft information process may or may not change as AI starts to potentially help some people and intentionally or inadvertently keep other people away from that information.
Great. I'll just take this question. And Adam, you can jump in as well. So I think it's going to change a lot. So there's a paper in the JFE, I believe, which by Zhongchen Chu, where he finds that if my Facebook friend experiences a hurricane, even though that person lives 3,000 miles away from me, I'm more likely to buy flood insurance. So this is like an example of the soft information you're talking about. And so I completely believe that there's this important role in kind of human-to-human interaction that drives these very important financial decisions that people make. And I would hope that, a lot of people now maybe just go to Reddit to find information. I have done that for papers. I'm not kidding about lender requirements. Reddit is a great source of information. But, there may be more platforms out there that emerge as, it becomes easier to vibe code an app, and you can kind of get people on board and create information sharing venues that didn't exist before. But I think it kind of cuts both ways. There's a WhatsApp group of my uncles where they trade terrible financial advice. And I'm a professor at Wharton, and I'm like, please don't do these things. And they're like, oh, so it can kind of cut both ways. And I think that's why there's going to need to be additional apparatuses from sources of authority, like a government, that can actually validate information. Yeah.
Thank you very much.
Also, a comment. So I was thinking that another area where AI could definitely be useful is, understanding how mitigation could help. Because it could be helpful from both consumer perspective, but also from an insurance perspective as well. So I was just hoping that, with more AI, with more power of AI, there could be more opportunities for consumers to understand that, maybe just do some what-if scenarios that if I were to do this or that, so just, it could be Chat GPT, and I think it could show some pictures and say that if you do this, then you could actually save so much of money, both on insurance, but also on your long-term benefits as well. But I think similarly from insurance, hopefully there's an opportunity for them to just offer a little bit more, some more products that are more mitigation. So I think there has been very less focus on mitigation so far. There's so much you can keep on paying for insurance, so there has to be focus on. So do you see those opportunities, or do you see some that really happening on on the both consumer and insurance side?
Yeah. So the answer, I think it's, and I think all the comments we've had, a lot of these comments have gone to the point that people are generally not paying a huge amount of attention, but at certain hinge moments they are. After a disaster, there's evidence that when they buy a home, if you expose them to evidence about to information about expected damages from natural disasters, that matters at that moment, but perhaps not generally. When you have to get an architect to draw up plans for a new house, and then you're worrying about, should I elevate this house or not? There might be these particular moments where people are very sensitive, and AI might be the right means to sort of inject or at least help people understand the landscape at those moments. But whether, I think all this speaks to the fact that the existence of ChatGPT as a product that people can use overall is probably not targeted enough. As we've talked about with the question of agents and intermediaries, maybe it's not people having access to it, it's their agents, it's their intermediaries. Maybe it's not the homeowner having access to it so much as it is, the architect or the engineer or whoever's drawing up the plans that implements these mitigation plans. And so I definitely think it'd be very interesting to understand, where is it that this AI-assisted or AI-augmented information would be most useful, and perhaps not just rely on the kind of, give everybody all the information all the time if they want it, which seemingly doesn't help so much. So, Pari? Yeah. Okay. Cool. Dave.
I would like to shift the discussion a little bit with behavioral economic here. You probably know that Zillow at one point had a flood insurance score,
yeah.
And with some pressure from the industry, they decided to remove it. And here we are talking about, I'm underinsured, but I don't know. Maybe I don't know. Maybe I don't find it's cost effective and this and that. So there's a decent amount of behavioral economic. And then you're speaking about all the anchoring bias. I just received the loss of my friend experienced the loss. How would you, integrate the behavioral economic studies and the AI tool access? I don't know if I'm phrasing my question right, but you see what I'm going after?
I think that the reality is that in some ways, at least in the U.S., AI access, for the moment, there's a component that's free. Of course, that's likely to change, and as they start charging and for more subscriptions and whatnot. But for the moment, AI access is free. But AI, even in that world where everyone can use it, we're already seeing differences in how people use it, right? And who's using it the most? It's sort of people in Silicon Valley who are software developers. They are probably the number one users. And then maybe, people in the other professional services. And then it's, the last person is going to be maybe like a blue-collar worker or minimum wage worker, right? They're probably using AI the least if we were to do a survey. And so that's even when it's free. And so the behavioral frictions, in my view, are going to be central in understanding how AI correlates with kind of existing differences across households and how they make decisions and how the sort of, I don't want to say irrationality, but the kind of the deviations from what we think is profit maximizing for the household. And that's only going to get worse as AI companies start to charge or limit access, right? So I'm not optimistic that is going in the right direction. I don't know how to address it. I think it goes back to fundamentals of improving financial literacy, which has been a constant topic in housing and mortgages and credit cards and pensions and retirement. And some of the efforts have been to just default people into contracts that are best for them, so that the easiest thing to do is to stay in what you have. And I think that has had mixed success. But I think that's why I'm less optimistic about AI solving some of those literacy issues. Malik?
I think this is more of a comment, but kind of to get a sense of some of the questions that were asked, which is like, Yeah, I think there's a clear case for maybe why AI or these other tools can maybe raise the floor for, so that everybody, when they make a mistake, it's not bad enough. Or, sorry, it's not as bad as it would have been maybe historically. But I guess I still kind of struggle with the idea of we just don't understand how this information diffusion process works. Like, I mean, your n equals 1 matches what I have in terms of like, you've got your uncles talking about investing stuff. You literally are putting a Wharton finance professor in there, like the best source of information to be like, don't do that. And they're still like, no, I'm going to do this thing.
Yeah.
And it's like, what more resource can you give them?
Yeah, exactly. I mean, I think it's, there's a limit to what information can achieve, right? Not all of this is just an informational availability issue. And that's, I wish that, my pleas about Dogecoin had been heated. They weren't. People lost money and it sucked, right? But what are you going to do? And it's, I think that, like, luckily for them, it wasn't catastrophic, but when it comes to something like homeowners insurance, you can lose everything in one go. And so it's so consequential. And there have been all these efforts from the government to get people to buy flood insurance. And there's all this stuff coming from industry to get people to buy flood insurance. But I haven't seen, I don't know how much of an impact they've had, right? So it suggests that informational treatments aren't going to be enough.
Are there other models from other nations where uptake is higher? Maybe in the United Kingdom, I think someone else in the workshop brought up that coverage is standardized, right? Clearly what we have is not working, right? And there is a significant degree of state paternalism already in our insurance market. We just refuse to admit it. What works?
Well, okay, yeah, the token foreigner. I think, okay, so for example, I think this home insurance, flood insurance contrast is instructive. Home insurance is not perfect, as Pari said, like maybe 70%, 30% of loss might be uncovered. But that's much, much better than flood insurance, where 95% of people don't have flood insurance. And I don't think people, apart from the fact that they don't know flood insurance and home insurance are different, the big difference there seems to be mortgage lender requirements, for example. So, it's again, without being too paternalistic and saying, well, let's just force people to do things that are supposedly in their interests. Here, the banks are, the banks are making this choice. They're on the hook for the mortgage, but there's some weird asymmetry between how they treat homeowners risk, like all the risk in homeowners insurance and the flood risk in flood insurance, right? And so, if we're sufficiently pessimistic about is AI going to help, or is it going to help, or might even accentuate some of the behavioral economic frictions that we've been talking about? The answer might be, and this comes to this question about what goes on in foreign countries, something more about, at mortgage level mandates or, mandates in general, such as exist for health insurance and this kind of thing. I mean, yeah, I don't know if you want to add, but.
Yeah, no, I think that's right. I think there's a hope that there is a sophisticated entity out there that can do the complex computational processing, and their incentives are aligned with the household, like in the case of mortgage lending, like Adam was talking about, where it works kind of in the same direction. But I also think that there is a role separately for some more standardization and simplification in contracts. Sometimes it's good to have many dimensions because you can get perfect customization for a particular person. And there's a welfare benefit to that, but I'm not sure if that welfare benefit outweighs the welfare cost coming from complexity. And that's kind of what Campbell and Ramadorai argue in their book.
I would say quickly, one of the things that has worked well in other countries, a lot of countries require homeowners insurers to come bundled with flood insurance and other things, and then they require the purchase. That can work. So a lot of these things, as I'll talk about soon, like they're legal regulatory architecture decisions.
Just a comment and a question, probably. So the AI, artificial intelligence, is a broad concept. So I'm not sure that we talk about AI all the time, but what is the AI, right? Yeah, it's just not just simply algorithm. Currently, in today's time, we talk about ChatGPT, LM, but if you, let's say, for the next couple of years, physical AI, robotic AI, right? So the robots, they come to our physical world, they're empowered by these AI models, large language models. They can not just provide the information, but to capture attention and help you action. So in that sense, for example, if there's earthquake coming, they send the robots to, save people, reduce claim, or if that's a hurricane come in, right? So they can send the robots to take photos for adjustments, evaluation, way more faster and way more efficient, and take less cost for the company, for the supply side, but also benefit the consumer side too. So I just wonder, what would be your thoughts about this future physical AI, robotic AI for both sides, the supply side, demand side?
The truth is, I haven't thought about that at all, but I'm happy to speculate on the fly. I think right now, from what I've read, maybe others can correct me if I'm wrong, most people are using AI as like a substitute for search. There are not that many people that are using it in more sophisticated ways. And that's kind of concentrated in industry. But thinking about households, like the majority of AI usage is a substitute for search. So I think that given that that's where things are, I'm not sure how much the distinction is important in practice. But in the future, as we kind of get as more and more people kind of learn about AI in school, in elementary school, and middle school, there's going to be more sophisticated usage of AI, and some of those more advanced techniques are going to be a part of day-to-day life.
Yes, even in the domain of search, right? So I think there's comments that early on there's a lot of litigation going to happening for the search, because if it is a question and answer from all these AI models, large language models, right? So you also do sponsor.
Yes. Yeah.
Right, so that's the problem. The ranking of the answers,
yes,
that will be controlled by cloud or OpenAI. They make tons of money,
yes,
but they're not the domain experts.
Yeah.
So what would be the downstream welfare of consumers in the household?
Right. I mean, that's exactly like my Google example with the hotels, right? And I think it's going to have huge welfare consequences, because even we have thought about AI as something that diminishes search costs. I think Ben said this earlier about search costs. One thing that could happen is that it lowers search costs, but another thing that could happen is it increases search costs. Because now I need to wade through 50 false flags from AI to get to the one that is actually relevant for me. And so it may actually make something like an insurance broker even more valuable, because if the insurance broker has a fiduciary duty and whatever, right? I don't know if AI will be a substitute for a broker.
I think there's another phenomenon related to what they're doing. We call it AI summary. Mm-hmm. And that's a big issue. I saw a working paper from UW, their team. I think they're trying to develop a method so that if you're an insurance company, right, if you search, I want to buy a car insurance tomorrow for my son, he's the first driver. What are you going to do? You search it, there's an AI summary. Boom, there's a lot of secrets of ingredients over there, because how much you pay in the advertising space, you're going to be in the summary, which part of the summary. So that's even more buried. Here's clear, you can see the logo.
Yeah,
but the AI summary is totally at the risk of the OpenAI model or the cloud model.
Yes.
Yeah, and I think that an implication of this, right, is especially if AI knowledge becomes more concentrated in terms of a couple of leading models or a couple of leading providers, right, is we go from a world where most people don't know a huge amount, but maybe it's somewhat uncorrelated, and there's a wisdom of the crowds. Versus we all know everything. We all think we know exactly the same thing, right? We're perfectly correlated. If it turns out that the one hurricane model that ChatGPT has told everybody to believe is wrong, then we're all wrong at the same time. And so democratization of knowledge might, in this case, just be complete convergence to the same one belief that may or may not be right. And so,
unless there's selection, right?
Mm-hmm.
At the risk of being a bit too extreme of my contrarianism, I'm not really convinced that AI actually makes a difference at all here, right? You already can purchase information, you can already purchase placement, you can already you look at the ads for Progressive, if you're a kid who needs automotive insurance, you're going to be like, oh, I saw that ad, I'm going to go to, that is not materially different than paying ChatGPT, right? Like this is not new, right? Like the information is available if you go and search for it. Is that like reasonably different, right? Like arguably you can Google for a hurricane model and get the one that the National Oceanic and NOAA gives you, right? Like you can do something. Like I think this idea that the artificial intelligence is going to somehow ameliorate or exacerbate any of the problems that exist in the insurance market. I don't know that I'm so convinced.
Yeah. I would say I'm more persuaded by the supply side case, right? That the insurers, people trying to make money off this, people trying to enter the industry, insure tech, startup, this kind of thing, they will use every tool they can find, right? They're looking for an edge. Whether the currently uninformed household, is going to massively change their behavior, or as Pari suggested, have this financial literacy gap accentuated by an AI literacy gap, I don't know, right? They might just do nothing. That might be the state of the baseline. But I think the people who have these strong incentives to make a dollar will follow those incentives and use it.
I'll just say, if you've taught undergrads, you'll now see that they use AI in every single thing that they do. And that doesn't mean, that it'll exacerbate or ameliorate existing behavioral frictions, but I think it does mean that people will be using AI to make financial decisions, and it just can cut in many different directions. Yeah. Mm-hmm.